Debt. It's a word that most of us dread, yet nearly 8 in 10 Americans carry some form of it. Whether it's credit card balances, student loans, or mortgages, the average household owes about $90,000. But here's the shocking part. More than 40% of people are only making the minimum payments. That means they're stuck in a cycle where it could take decades to pay off what they owe. Now, imagine trying to pay off your debt using strategies that might seem smart but are actually making things worse. Crazy, right? Well, many people fall into these traps every day without realizing the cost. In this video, we'll uncover the worst ways people try to pay off debt. Some methods sound good on paper, but in reality, they can keep you stuck and slow down your progress toward financial freedom. Get ready to discover why debt avalanche, minimum payments, and consolidation might be doing you more harm than good. You'll learn what strategies are keeping you in the red and what smart moves you can make to turn your finances around fast. Stay tuned. What you're about to hear could change the way you approach debt forever. Chapter 1. Debt avalanche? More like a debt landslide. If you've ever tried to pay off debt, you've likely heard of the debt avalanche method. The idea is simple. Pay off the debt with the highest interest rate first, while making minimum payments on the rest. Sounds logical, right? But here's the thing. It often feels like a never-ending struggle. Studies show that over 60% of people give up on paying down debt after just a few months. Why? The avalanche method can feel like you're not making progress. For example, if you owe $10,000 on a high-interest credit card but also have smaller debts, tackling that high-interest debt first can take forever. The emotional toll of seeing your smaller debts lingering around can make you lose motivation fast. In fact, behavioral economics points to a powerful factor: instant gratification. The human brain craves quick rewards. When you see that smaller debts vanish quickly, it provides a sense of accomplishment. But with the avalanche method, that immediate payoff is lost, leaving you frustrated. Instead, consider the debt snowball method, which tackles smaller debts first. It's more emotionally rewarding, even if the math doesn't always make sense. Dave Ramsey, a financial guru, says, small wins lead to big wins. And sometimes, the emotional boost of paying off smaller debts is all you need to stay on track. So, while the avalanche method might seem like the smartest approach mathematically, it can feel like you're stuck in quicksand. Your motivation erodes, and your momentum fades. Chapter 2. Minimum payments. The slow death of your wealth. When it comes to paying off debt, many people default to making only the minimum payments. It seems like a safe, no-stress option. But here's the truth. Paying the minimum could be the slowest way to kill your financial future. Consider this. The average credit card interest rate in the US is around 20%. If you're only making the minimum payment, most of that money is going toward interest, not the principal balance. This can drag out your debt repayment for years. In fact, the Federal Reserve estimates that someone with a $5,000 credit card balance paying only the minimum will take 13 years to pay it off, and end up paying more than $7,000 in interest. One of the biggest issues with minimum payments is that they're designed to stretch out the loan as long as possible. Credit card companies love this setup. It's a steady stream of interest payments that build up over time. If you're trying to build wealth, however, this is the worst thing you can do. As Warren Buffett once said, the more you learn, the more you earn. And what's the first thing a value investor learns? That paying interest is a wealth killer. Instead of paying the minimum, put any extra cash you have toward your highest interest debt. Every extra payment reduces the interest you'll pay over time, and it'll speed up your path to financial freedom. Chapter 3. Consolidation. The Great Debt Mirage. Debt consolidation sounds like a magic fix, but it's often a financial mirage. The idea is simple. Roll all your debts into one loan with a lower interest rate. At first, it seems like you're getting a deal. One payment, lower rates, less stress. But there's more to the story. Let's say you consolidate your debts with a personal loan at 10% interest. It sounds great, but you could be trading short-term relief for long-term danger. First off, if you're not careful, you might run up your credit card balances again, thinking your financial problems are solved. Suddenly, you're in deeper than before. A study by the National Foundation for Credit Counseling found that about 40% of people who consolidate their debt end up accumulating even more debt within a year. That's the opposite of what you want. Consolidation doesn't fix the root cause of your debt, it just moves it around. Think of consolidation like a band-aid on a broken bone. It might help you feel better in the moment, but it won't address the real issue. Instead, focus on cutting back on unnecessary spending, building an emergency fund, and tackling your debt with a clear, methodical approach. Real financial growth comes from making the tough decisions that set you up for long-term success. If you're finding this content helpful, don't forget to hit the subscribe button so you can stay updated with more tips on managing your finances. Chapter 4. Borrowing more to pay off debt. The investment, Hail Mary. It may sound counterintuitive, but some people make the mistake of borrowing even more money to pay off existing debt. Whether it's a personal loan or another credit card, they believe that getting a fresh loan will allow them to eliminate higher interest debt. This is a dangerous game of juggling financial burdens, and it often leads to disaster. This strategy can feel like a Hail Mary pass in football, a last-ditch attempt to fix a problem that's gotten out of hand. However, studies show that taking on more debt often leads to a cycle of borrowing that is hard to escape. The Federal Reserve's 2020 data revealed that about 7% of Americans were borrowing to pay off existing debt, only to end up further in the hole. When you borrow more money to pay off debt, you might lower your interest rate temporarily, but you're just shifting your problems around. Instead of actually paying off your debt, you're prolonging the process. Plus, it can create a false sense of security. Author Robert Kiyosaki once said, "If you're in debt, you're not in control." And borrowing more to pay off existing debt means you're not really in control of your finances. You're simply trying to escape one trap by jumping into another. The smartest move is to pay down debt in chunks, focusing on one debt at a time. You might need to cut back on spending, but that's a small price to pay for long-term financial freedom. Chapter 5. Paying interest just to keep your credit score high. The credit score trap. One of the most misunderstood financial myths is that you need to keep a balance on your credit cards to maintain a good credit score. While a strong credit score is important for financial health, holding a balance just to improve your score is a terrible strategy. Paying interest on your credit card debt only makes the lender richer, not you. Data from the Consumer Financial Protection Bureau reveals that more than 40% of Americans carry a balance on their credit cards month after month. A large portion of these people believe that maintaining a balance is helping their credit score. But in reality, credit utilization, the amount of credit you're using compared to your total available credit, is only one factor in your credit score. And it's more about how much you owe compared to your limit, not whether you carry a balance. This is one of the worst financial decisions you can make, as it results in paying unnecessary interest over time. For example, if you owe $5,000 on a credit card with a 20% interest rate, just carrying that balance can cost you hundreds or even thousands of dollars in interest charges each year. Warren Buffett warns, the most important investment you can make is in yourself. This includes managing your finances wisely and understanding that paying interest on credit card balances isn't an investment, it's a loss. Focus on paying off your debt in full each month. Your credit score will improve over time without the burden of high interest. By doing so, you'll also save money and avoid dragging out the process of becoming debt-free. Chapter 6. The Debt Snowball. A temporary fix, not a lasting strategy. The debt snowball method, popularized by Dave Ramsey, is a strategy where you pay off your smallest debts first while making minimum payments on the larger ones. The idea is to build momentum by knocking out the smaller debts, which can feel like a quick win. But while it may seem effective at first, it's not always the smartest long-term approach. When you pay off smaller debts first, you feel a sense of accomplishment, which can motivate you to keep going. However, mathematically, the debt snowball may not be the best way to save money in the long run. Research from the National Bureau of Economic Research suggests that people who use the debt avalanche method, paying off debts with the highest interest rates first, end up paying off their debt faster and saving more money in interest. The reason the snowball method can be a temporary fix is that it doesn't focus on eliminating the highest cost debt first. If you have a small $1,000 debt with a 5% interest rate and a $5,000 debt with a 20% interest rate, the snowball approach would have you tackling the $1,000 first. But over time, that 20% interest on the larger debt compounds, and you're paying more in the long run. In his book The Millionaire Next Door, Thomas Stanley talks about the importance of long-term wealth-building strategies. The snowball method is fine for short-term motivation, but if your goal is to build lasting wealth, it's better to focus on high-interest debt first, reducing your costs and accelerating your debt repayment. Of course, this doesn't mean you should throw out the snowball approach entirely. For some, the emotional boost of clearing smaller debts may be the key to staying motivated. But it's important to recognize that the snowball isn't the most efficient approach from a financial standpoint. Conclusion: the strategies we've covered today, borrowing more debt, paying interest to boost your credit score, and relying on the debt snowball method, may seem like simple solutions, but they often lead to more financial trouble. While they provide temporary relief or satisfaction, they don't address the root causes of debt and can drag out your financial journey. True financial freedom comes from creating a strategy that works for your specific situation, focusing on paying off high-interest debts first, avoiding unnecessary borrowing, and learning to live within your means. And remember, managing debt isn't just about the numbers, it's about building habits that will help you avoid the same mistakes in the future. Focus on making smart, informed decisions, and you'll be well on your way to financial independence. Don't forget to subscribe if you found these strategies useful. Stay tuned for more practical financial tips that can help you take control of your money and your future.